lights are too bright.
I could see anyone waving right now.
He must be waving. He's
Okay,
waving.
go ahead.
He's waving. Hello. Welcome, everyone. So, I'm Felix Salmon of Fusion. Ooh, exciting. I'm Felix Salmon of Fusion, and welcome to the panel on digitizing Wall Street, technology, finance, regulation, how they all come together, and where they clash and create enormous conflagrations of debate. And with any luck, we are going to have some conflagrations of debate around here. We want you to be involved. I'm going to try an experiment here, which may or may not work, depending on whether my iPad is working. My email address, as a slide up here, is felix@fusion.net. And ideally, as we sort of go through the discussion and the various topics here, rather than just waiting until the end for questions, if you have questions along the way, I'll try and be keeping an eye on if anything interesting comes in over the transom, and I can ask you a question immediately when it's relevant instead of 50 minutes after that discussion has happened and everyone's moved on. So send me some emails over the course of this discussion. That would be fantastic. And that is, and then let me very quickly just run down the panel here. You have all of their bios and everything, so I'm not going to go into any details really at all, except to say that Rich Daly is from Broadridge, Adena Friedman is from Nasdaq, I can't even get that. David Siegel is from 2 Sigma, which is a sort of algorithmic buy-side shop. Mike Weil is from RCS Capital. We'll find a little bit more about what he does, but it's more sort of retail-oriented. And finally, at the end, we have Daryl White from BMO, who's more institutional. So this is a very capital markets-oriented panel with Nasdaq and 2 Sigma and everyone else. So I'm warning you right now that the overwhelming majority of what we talk about is going to be capital markets. If you're interested in the non-capital markets part of Wall Street, we might touch on it, but we're not going to have a huge amount of time on that. But let's start, I think, with Daryl, since you're way over at the end there. I want to know about technology and finance, and I want to know what can technology do, what can computers do, what can robots do that humans can't do, and should we be afraid of that? Is that making things scarier?
Well, being afraid sounds like a scary movie, so I don't think we have to be afraid.
Because there have been scary movies.
Yeah, I don't think we have to be afraid of the scary movie, but I do think that the question as to what the machines can do and what the humans can do has to be decomposed. And when you de-average that question into different parts of the capital markets, as I think about my role on this panel as probably the old school sell-side banker on the brokerage side of the business, we look at it in the different businesses that we have. If you look at an investment banking business or a corporate lending business, the evolution in technology has been that. It has been an evolution, but it hasn't been particularly dramatic. I mean, some would say that the introduction of Excel models in 1992 was probably the most evolved we got, and since then it has been a high-touch, high proprietary intelligence, and low-tech model. On the sales and trading side of our business, there's obviously a very different model, and technology has been a huge enabler as far as the cost to serve is concerned, as far as trade efficiency and settlements and clearing. But even in that side of the business, I would say we always have to remind ourselves that the man and machine marriage, as it's called, is critical, because while the computing and the analytics of the computing have been very valuable and have provided effectively a better result to the customer, in behind that there's a very significant human management of risk, of liquidity, of inventories, without which what you're really talking about, without which is a complete blind pool ecosystem where all we would have would be order matching through the whole financial ecosystem, and that's not quite where we are. And there's probably a segment of the marketplace that that would find that important and does find that important, and for that, that should exist. But there's a very large segment of the marketplace that looks for service that reaches well beyond that. So I think it's important, but I'm not in the scary category.
Mike, are you scared?
You don't want to know. No, I don't think you can be scared. I think that technology is something that is everywhere in all of our businesses, and all of our businesses are a little bit different. The marriage of human capital with technology, as just described, makes the industry better. It makes it more efficient. It gives us access to better opportunities, but also we're in a regulated industry, heavily regulated industry, and it continues to grow. Without the technology, we are fighting a losing battle. So I think that, again, from that standpoint, we continue to embrace technology. It opens new doors. The world gets faster and faster. And as we talked in our pre-panel, if we are going to talk about a leveled playing field, it is absolutely critical that we all embrace technology and use that technology to help us find the best opportunities and the way to maximize that, whether it's for a retail client, an institutional client, or any part of the spectrum.
Now, Rich, you're a technology bull in the same way, right? You're bringing technology into the marketplace. You're mostly in sort of post-trade technology, but you're kind of similar, saying that technology, yay, great, and the main thing that regulators need to do is just kind of enable that.
Well, there are two things. So first of all, technology is going to continue to evolve. When we talk about robo, I think that's overstated. What it really, to me, is bionic advisor, where you're putting technology behind an individual, because at least in retail, it's going to continue to evolve, where successful FAs supporting investors, retail investors, are going to need technology to keep up with the evolution of the playing field, which is being driven by technology. So as this continues to evolve, you're going to see, look, when you look at what Schwab did by revolutionizing the market, okay, and enabling the direct model, it doesn't seem so revolutionary today. People will be on a panel 10 years from now, and they'll be talking about robo or bionic, as remember when that was meaningful in the dialogue versus what we're talking about today. The regulation, though, is the piece that is not going to change. I think it'd be tough to find someone on this panel or in this room that believes that regulation is not going to get more complex, not less complex. So it's how do you execute this on things like whether it be robo or other business models out there where investors are still protected and at the same time have the ability to take advantage of technology to enable them to get better returns in the increasingly complex world we live in.
David, the capital markets have an unprecedented level of complexity. We have, Adena, how many stock exchanges are there now in America?
In the U.S.?
Yeah.
Well, there are 3 registered stock exchanges.
How many places can I?
So there are over 30.
Over 30 different exchanges. There's all manner of insanely complex technology underlying them, never even putting to one side all of the ultra low latency stuff. The complexity is too much for anyone to really understand. So my question for you, David, is it not the case that the more complex a system becomes, the more catastrophically it fails?
No, it's not the case. If you think about aviation, aviation has never been safer today than in its history.
And its failures have never been more catastrophic.
No, not true. So in the early days of aviation, planes were crashing all the time and people were dying all the time. And people have just not focused on that. And in fact, air travel was quite dangerous, even just a generation ago. And there's been nothing but vast increases in complexity using a range of algorithmic approaches and vast increases in aviation safety. I mean, clearly flying in an airplane today is much, much, much safer than driving a car. But flying in an airplane today is much, much, much safer than flying in the early Pan Am propeller planes that would take you from New York to London. And so, in fact, the world has gotten much better at managing vast increases in technology and harnessing it for the public good.
Okay, I'm really trying to get a debate going here, and it's not really working. So, Adena, you're going to have to help me out.
Oh,
Tell me about and if you don't give me the answer I'm looking for, I'm going to prompt you in a minute. But tell me about this, the question of regulation. Is it the job of regulators just to go, gee whiz, wow, that technology is amazing, let's let them run with it because technology is awesome, or is there something else which they ought to be worried about?
well, I think that first of all, regulation doesn't just sit around and get excited about looking at technology. I mean, their job is to protect investors, their job is to protect the markets. And I think their challenge is that technology and technological innovation happens extremely quickly. So the pace of change and the pace of development in the markets, I think that it's much faster than anything that the regulators can really keep up with. But their job is not just to look at it and say, wow, that's really cool. Their job is to investigate it and dissect it and understand whether or not it's creating the right environment for investors. And that's very challenging because there's so many technologies that exist today.
Right. And so can you give me an example of a regulator looking at the technology, understanding that technology, saying, that technology is not actually good for investors, and then sort of saying, you can't do that?
I mean, behind the scenes, I think that they investigate new members and what their trading strategies are and the technologies they're using to determine whether or not there's fairness in what they're creating. So behind the scenes, I think that happens in the approval process around a new member in the market generally. But you're not going to read about that because that's all behind the scenes as they're putting their filings in.
Right. And actually, I mean, I remember reading, 3 years ago now, about the Winklevi and their Bitcoin ETF, which is obviously non-existent. So
well, that's still actually under review at the SEC. Yeah, so it's not non-existent. It's still going through a process because it is fundamentally different in terms of understanding what is a Bitcoin. I mean, Bitcoin as an instrument, what is it? And so therefore, who regulates it and how should it be regulated? And how should the ETF be created to make sure it's securitized properly? So there's a lot, when there are things like that just fundamentally bring something new to the markets, the SEC does have the ability to kind of investigate ahead of time. But if there's something that's a new technology that's coming in just to make things, new algorithms that are being placed in the market by firms that don't need to seek approval for those algorithms, they happen without their knowledge, or they have to regulate after the fact.
Mike,
so,
is that
Felix,
something
let me see if I can add a little controversy to the panel.
Thank you.
Because I know that's what you're looking for, and it's something that as someone that's focused on financial advisors and their relationships with retail investors, I think we are at a crossroads that really involve the intersection of institutional versus retail, and that they don't always play well with one another. And the points that we worry about in the retail world is really access and opportunity. The technologies that are out there tend to favor the institutional side of the equation.
And earlier we were giving the example of IPOs.
Well, whether it's IPOs, whether it's high-frequency trading, whether it's just overall access points, what we on the retail side look to technology for is to help the financial advisors have the tools to deliver that to their clients, at the same time marrying that relationship piece that, whether it's robo-advice or any number of things out there, that technology becomes a tool to the FA, not a replacement of the FA.
Okay, so basically I'm getting the message here that there are certain areas where institutional investors have an advantage over retail investors, and the job of technology is to sort of turbocharge retail so they get brought up to the level of institutional.
As best as possible. I mean, we still worry that the preference does naturally favor an institutional investor.
Well, If you think about other industries, take Uber and car services. So Uber is basically putting out of business the smaller traditional car services and taxi drivers. And it's a technology play. And so because Uber built a very scalable, data-driven business, it becomes harder and harder for, let's call it the retail car services to compete with the institutional car service. I think that you can make exactly that analogy with investing today. I think that because of big data techniques and the power of computing, it becomes harder and harder for a small player who doesn't have the resources to harness the vast amounts of available information to make investment decisions. Surely you would imagine that the more information that you have available to yourselves to make an investment decision, the better job you can do making that investment decision. It's quite hard for a retail person to compete with an institution that is collecting terabytes of data every day from around the world and using high performance algorithms to for example, using AI techniques and other big data approaches to make hay out of all that information. How would a retail person really
But if we go back to the 33 and 34 Act, a lot of that was focused around creating that more leveled playing field. And I just think it's a constant point of friction that will always exist.
I agree.
Okay, so let me come in with a question here. Thank you all for your questions. And yes, we'll have the slide up again. It's felix@fusion.net. Bring them in. Terrell Gamble, and I have this question, which is going to go to Rich because I know he knows the answer to this one. Has got this question, which is there even such a thing as a retail investor anymore? Haven't we moved on to the point where retail investors just buy passive index funds, and the only people who are actually buying and selling individual stocks are exactly these sort of highly sophisticated institutions?
Not only is there a retail investor, but the retail investor is very significant. Mm-hmm. So in Broadridge's other business, which is the communications business, we host 85% of the shares in every annual meeting in North America and well over 50% everywhere else in the globe. But particularly in North America, you've got 30% of the shares owned by retail. So the retail investor is alive and well. The retail investor clearly is, I agree with the comments, is, the playing field isn't completely level, but technology is going to be the answer. Technology is going to be the answer to the future of Wall Street in terms of leveling it. And the regulators, for quite some time, and they're in the very unenviable position of trying to keep up with technology. But they do want technology to enable a level playing field. What they don't want technology is to enable people being able to be fleeced more easily. So retail is out there, retail matters, and even as this corporate governance debate goes forward, retail is going to start to play a more significant role, because you also have the conflicts out there of, well, what's a return? Is a return meaning that I get somebody to lever up, buy back, and then I get out 4 days later? Or as a return, I want this stock and I want to get a dividend and I want it to grow and I want to support its growth over the next decade. So technology is going to add to all of these dynamics, but retail will be a player, and firms like Cetera are getting technology behind retail, is going to make a difference for people who need advice, who aren't through divine intervention going to wake up in the morning and have technology chip planted. They're not going to use Siri to go out and make their investments. Say, Siri, what should I invest in today?
That's not a bad idea. I should try that one day.
All right. Well, I don't think you'll do that well when you do.
Siri would have just told me to buy Apple stock, and that would have been awesome.
But I would actually take the other side of that. I would say that the day is coming when you will be able to speak to an AI system and get substantially better advice than any human advisor could give you. I don't think that this is that far away. I think anyone betting against that.
I think that is a wonderfully Wall Street view. And we're based in New York, so I get it. I think that one of the funny experiences 5 or 6 years ago, we were debating an investment in a retail operator called Tractor Supply Company, and we were on the 15th floor of a high-rise in Manhattan, and people were saying, well, who would ever go to a Tractor Supply store? Well, everybody but us sitting in Manhattan would. And we tend to lose our view of what Main Street and retail really is. And I think this, being at the Milken Institute, this is a perfect time. I've enjoyed talking to a number of people from the healthcare industry over the last few days, and we talk about cures and quality of life and how do you measure that. And the statistics around how long people are living now in the U.S., it's, the average age is up into the 80s. And that's an interesting conversation when you start factoring into retail advice and just the financial industry as a whole, because I think the paradigm is changing completely. It's much less about the return of a single investment, whether that's a stock, an ETF, whatever it may be. And the conversation and what I think technology will play a role in, and the regulators, is the change in focus from investing to planning. And I know that that's a very small nuance, but when we're talking to people about how their career work, whether they're working for 40 years or 50 years or whatever it may be, we're no longer in a defined benefit world. We're in a defined contribution world. So people are saving as they're working. They're much more responsible individually for their retirement. And when they turn to that point where they're either planning for or at retirement, it's really much more of a twist on the endowment model than on the latest trading technology. Now, the trading technologies on the institutional side will play into that because it will be part of the optimum structure. You will always have equities.
But what we need is people to help us plan our lives rather than eke out an extra 10 basis points.
And that's exactly right.
Yeah,
Felix.
I mean, I would say that the U.S. economy is one of the richest set of investors in the world. I mean, it is the richest set of investors in the world. There are lots of different strategies that play out in the markets every day. One of the great things about our economy is we have a classic retail and we have a very, I would say, very advanced institutional investor, all playing in the same markets. And technology has enabled those retail investors to get access to the market instantaneously, get access to information instantaneously. But they're making a human decision to make an investment over a long period of time. And there are other investors who use computers to make very quick decisions, to make shorter term or even longer term investments over time. But one of the great things about the U.S. economy is the confluence of all of those strategies together that makes it a rich place to invest. And my personal view is, with $5 trillion of assets under management still in active hands and another $1 trillion in passive investing, and then you have $19 billion in robo-advising so far, it's certainly growing. It is growing very fast, but it's still, there's a rich set of investors that you can basically play for. And I think that different strategies will always exist: the human strategy and the computer strategy.
Okay, now the questions are coming in. Felix at Fusion.net, you guys are fantastic. I'm going to have one more question on it because you guys all really love talking about robo-advisors. So I'm going to have one more question for Daryl here from Ryan Smith, who has emailed in saying, how will the dynamic change when we have a generation, this millennial generation which is coming up, more comfortable with an algorithm they don't have to talk to rather than the financial advisor on the phone? Because everyone, I feel I'm an old, but I know that I'm typical in this respect of millennials. I hate talking to people on the phone.
Right. Well, Ryan's probably quite right that dynamic isn't going to change, and there's going to be an increased interest in being able to do things directly as opposed to having to talk to somebody on the phone. But I actually think this comes back to, we got onto it and we left it very quickly. If you think about the intersection of the regulatory regime with the technology changes, the question will become more and more relevant. If you went to the extreme and there was no personal service, everything was done electronically, then you get to the question as to how the regulators are able to ensure that they're monitoring. We talked earlier about level playing field, which you might argue that would be a level playing field, but you also talk about systemic risk. So if a regulator's primary role is to think about systemic risk in the marketplace, it is possible that they could get to a place where they're able to affect their jobs and monitor systemic risk in that world. But you can also see how it's possible that they can't, because one of the unintended consequences, and most regulators would tell you this, of the increased costs on the financial system has been the dislocation of capital. So you've seen liquidity dry up in the traditional universal bank broker-dealer system and go into non-regulated entities for regulatory arbitrage. All of those investors can participate there, in theory, if they can find their way to do it without speaking to a person. And in almost every single one of those transactions, there's no regulator involved. So how we find that marriage between the technology and the regulatory architecture, to my mind, I haven't seen it yet, and I don't know that the ability to keep up with the technology is going to be fast enough. So I think there's going to be a slow walk to a new place, and the comment that was made earlier about having all of these venues available, particularly in America, but increasingly in other places in the world, will continue to be true.
So there was a question here from Susan Ox, which is exactly about this, which is, she asks, when are we going to see tech-enabled disintermediation of capital raising? If a company wants to issue bonds, when is it going to be able to just sell those directly through some kind of tech platform to investors? Or if it wants to raise equity, when is it going to be able to just IPO on some kind of a tech platform and just disintermediate the banks?
When the regulators don't care, and when those investors don't care about a third-party validation of the investment that they're making.
I think that's a key issue. I think that people have to remember that underwriters do in fact play a role in capital raising. They are there to make sure that they are basically playing a role with the company. They're doing a lot of diligence on the company. They come in for days and do in fact due diligence. And I think that they do really look at the underlying quality of the company and what the risks are, making sure those risks are properly disclosed, et cetera. So they do play a role. I think that in the case they do place the securities, but they also are there as an underwriter to back the company up and use their own balance sheet or the shoe to stabilize the stock. So there is a role that underwriters play. I think that in terms of allowing companies, though, for maybe a portion of their IPO to do something through an electronic mechanism and have some sort of auction or some other mechanism to be able to attract certain investors into the IPO for a portion of it could be interesting. But even that would probably be facilitated through some sort of broker-dealer.
So this is the perfect segue into what I consider to be one of those very rare instances where regulation has gone, we had a sort of technological advance, and the regulation went so far, embraced it far too much, and I think a lot of the panel will agree with me on this, was the Jobs Act and crowdfunding, and the ability of small companies and even pretty large companies to sort of do an end run around certain regulations and just raise capital directly from the public. Adena, was that basically Congress stopping the regulators from doing the thing which they really should be doing in terms of protecting the public?
Well, I think crowdfunding just came about in an organic way. With innovators and technology that came about that allowed, and it started off, I believe, more on the charity side, so in terms of crowdfunding for microlending or crowdfunding for certain projects or films or things like that, and it's then gone into crowdfunding for companies. I think that certain regulators around the world are catching up faster. I believe that in the UK they're coming around a little bit more as to how crowdfunding should occur. Here in the US, they're still looking through exactly what kind of limits or issues that they should put on crowdfunding. And they do put limits in terms of no more than 10% of your wealth and can be put into crowdfunded investments and things like that. But there is still, I'd say, a whole regulatory regime that will probably evolve in the near term to help basically to make sure that crowdfunding is done in a level playing field or as level as possible.
But isn't it going to be much harder for the regulators to do that given the existence of the Jobs Act?
Well, I think that we can always expect continued evolution of that regulatory piece. I think that I don't think everybody understood exactly what they were allowing when the Jobs Act came through. But I also think that it opened a door that is a very interesting door to open. And again, you can't hold back that technology piece, and that is something that crowdfunding does embrace. As as all new industries evolve, and I think that crowdfunding, you can argue crowdfunding is here to stay in some form or fashion. And whether it's through access to the accredited market or however it gets modified over time, it is another way to access capital. Because again, I do have a leaning towards that retail/Main Street piece, and where on the institutional side, there are certainly well-established ways to access that capital. On the non-institutional side, there's a constant push for better and more efficient access, and I think that you'll really see that evolve. And at the risk of upsetting the bankers in the room, I think that one of the things, as we were talking about the IPO market and technology and will that evolve, I do absolutely believe in the value of the underwriting and what the investment banking community does in a good IPO. But if there is a piece of that becomes more efficient, as efficiency increases, there's typically a downward pressure on fees. And as
that never happened in the IPO market.
Well, it happens on a regular basis. When the IPO market is hot, fees are much different than when the IPO market is under pressure, because there's a constant fight for that capital. So it's just another access point that will create an overall.
Disintermediation has been occurring in all industries, including finance, over the years. So I think one of the key roles of technology
tell me
is
about this,
disintermediation.
I'm gonna push back on this one, since I don't know if anyone else will.
But Felix, your Jobs Act comment is out of context, because at the same time, the headline right now is Elizabeth Warren and the elected leader of the free world talking about going from suitability to a fiduciary standard, which is a standard dramatically beyond where we are today. Mm-hmm. So to think that the regulators and the elected leader of the free world are simply going to watch people throw money out there and, well, if they lose it, they lose it, just isn't going to happen. They're attacking.
Okay, so all right, the point taken. But let me come back onto this disintermediation point, because this is fascinating, and it's also crowdfunding. If you look at what happened to peer-to-peer lenders, a few of them sprung up. Most of them didn't do very well. Basically, two survived. By far the biggest is Lending Club, which is not a peer-to-peer lender anymore. What happened at Lending Club is you wound up getting re-intermediation, that you still got borrowers borrowing, but the lenders were no longer individuals. The lenders just became big institutions. And it's great. And we have a question here from Audrey Jacobs, who says that last year crowdfunding was about $10 billion across the rewards and the equity space. These are small numbers, and if they ever do rise, isn't it the case that the institutions, the hedge funds, and the big players are going to wind up crowding out the opportunities which exist for small people?
Well, being a small person,
as a small person, right?
I will say there's such a difference between an investor with $1 million net worth and an individual with $250 million net worth. And I think when you bring in,
I love the fact that Milken, small means $1 million.
Well, I think that across this country, we do have a very powerful under 10 million net worth base. That whether it's 1 to 10 or 2.5 to 10, and they're typically entrepreneurs. They're spread out across the country, and they just don't always have the same invite to participate that a 20, 30, 50 million dollar individual does. And these new types of opportunities, whether they're driven through crowdfunding or any number of different things, as an accredited investor, they have a different approach. They have a different concern with the equities market and how to benefit from it or access it efficiently. So I think you are going to continue to see a pushing of new access points, and that'll be very interesting over the next decade.
Yeah, I would say that I think that the innovation, I'll take a different angle here, the innovation in these markets is going to occur outside of the United States. So I agree with the people here that are making the observation that regulators and the entrenched players in the US and Europe, for example, will stifle innovation. This will not be the case in sub-Sahara and other emerging markets. In fact, right now, if you look at M-Pesa and other firms that are involved with microinsurance, micro-lending, micro-banking, telephone companies are now, entering into the transactions in regions that have never been served by official banks. That's actually where all the innovation is occurring. So if you really want to get a picture of what finance in America is going to look like in maybe 20 years, just keep an eye on what's going on in the developing markets.
Which gives me the perfect segue to Josh Miller's question, which. Well, no, it wasn't Josh Miller's question. I apologize. It was Ryan Smith's question. No, wait. Anyway, it was a question in here from someone about the blockchain. Adena, is this going to be the thing which finally makes finance genuinely global and is going to allow technology from sub-Saharan Africa to take over the U.S.?
I think that right now, I would say that most of the players in the markets are just now trying to determine what exactly the blockchain can do for the financial system. I do think we all agree that there's great promise to the technology that's been created with the blockchain in terms of dealing with credit risk. And the ability for essentially you to know who you're buying from and know who you're selling to before you make the trade, as opposed to waiting for 3 days to find out whether you settle. So I think that the blockchain can definitely be used in that type of arrangement, almost to create a cash market.
Are you saying that it's a good thing for transactions to be irreversible?
I think that it allows you to have a better understanding of your credit risk as you're trading, and therefore, theoretically, you could use the blockchain to create almost like an electronic cash market, right? And so I think that there are innovations that could occur in blockchain that will be very, very interesting to the financial services sector. Whether or not it makes it so that someone in Africa and all the technology that are occurring in Africa suddenly get easily exported here, I think that's kind of a different topic altogether.
But let me come back to this question of irreversibility. I mean, as a retail investor, as someone who's very sort of small and peripherally involved in financial markets, it really worries me that I might press a button and then all of my money is gone.
Oh,
and if
that irreversible.
I know that if I'm banking with a bank, and if some mistake is made, then there's some way of reversing things. With the blockchain, there's no way of reversing transactions, and I'm not sure this is a good thing.
Right. So that's you're talking about just how you deal with commerce on the internet in terms of an irreversible transaction. That's a different concept then, and that's really using Bitcoin to trade. That's basically truly using electronic cash. I think the blockchain is an underpinning of that technology that allows for credit risk to be not necessarily eliminated, but certainly reduced. And that's a very different concept
do you mean
than
credit risk or counterparty risk?
Counterparty risk.
Right. Okay.
Sorry.
Anyone else wants to jump in on Bitcoin and blockchains?
Well, even with the traditional financial system, you're not guaranteed to get your money back. I mean, if you were to wire money to a bank abroad, and there's no promise. It's just by convention that the system will return the money. It's possible to, and so you could have the same convention with the blockchain, but you'd have to deal with people that you trusted to do the right thing in the case of an error.
Rich, you're deep in the infrastructure of Wall Street. You do the pipes and the nuts and the bolts. What's your view of the blockchain? Is this going to disrupt stuff, or is it just never even going to come close?
What we're really talking about is right now, if you look at the industry overall, there's a challenge for everyone, particularly the large financial institutional participants, in that ROEs, because of regulation, have really been slim, right? And there's the other half of the regulation to be implemented. So it has to come from somewhere, Okay, you can't have large financial institutions getting to mid-single-digit ROEs and thinking it's a sustainable model. So technology, okay, whether it be the blockchain or ways to make the market more efficient, are going to need to be deployed to take this cost out. All right, so what you're going to have is the whole clearance and settlement process right now, which is still fairly complex. Okay, so it's going to go from 3 days to 2 days, but there really needs to be this generic cost out there taken out. All right, where everybody's doing the same thing over and over in the clearance and settlement process. So there's going to be the creation of more utility plays out there, and blockchain type technology can be part of that. But by shortening the settlement cycles, by eliminating repetitive steps that everyone's doing, okay, most importantly, the reason why that's going to happen is not because of some slick technology, but it's going to enable these firms to take out significant duplicative costs between them. And that's what's going to drive, I believe, this settlement process as we go forward. Because again, by the time Basel gets implemented, you're going to see ROEs get slammed again, and they're barely back to double digits right now.
You know, my heart is bleeding for these poor financial services firms, single-digit ROEs. I mean, how are we going to solve this problem?
Maybe I can help. I can help you solve the problem because. I mean, it is a real issue. Naturally, we can. We don't need to have our hearts bleed for sure. But when you do see, I mean, it doesn't happen very often, but it does happen if you look at other industry structures where you have an industry that, because of a change in the forces in that industry, have a 4, 5, 6, 7% reduction in their ROE when those ROEs were only in the mid-teens to start with. It's a very material development, and so the package of responses that Rich is talking about, they do include a big slug of technology. There's without question, there's a response that has to involve figuring out how to get leaner and better at doing a lot of work, including the stuff you don't see behind the curtains, everything that happens in a global middle office, everything that happens in settlement, the conversation about can we have industry utilities that can do the same work and access customer data together as opposed to having the same customer have to fill out the same form by the 20 banks that they deal with, which is just an irritant. So in a way, there is an opportunity. I think we're right at the inflection point where technology is helping. It's helping take costs out to make up part of the ROE that's been lost, but there's also a commercial opportunity that we're starting to talk about in the industry, which is some of the stuff that we have been forced to do by regulators to reduce systemic risk, and I should comment, I think it has reduced systemic risk at a cost, has created a wealth of data that didn't exist before in the system. And so the ability to mine that data and the ability to understand how to better serve customers as a result of having that data and not spending our time pissing them off because we ask them the same question 5 times or 20 banks ask them the same question 5 times and now they've done 100 things that they could only do once. That's an important conversation.
So for those of you...
I think that's where we start to find now, last year, next year, I don't know exactly where it is, but we start to find that inflection point.
If you are, by the way, playing the official Milk and Global Conference drinking game, I think that counts as a big data thing. You can take a drink. But you're talking about systemic risks, and I want to spend a little bit of time on this because, there's a great question here from Gillian Sandler. Thank you, Gillian, for this one, because I think this is something which already exists in the bond markets, and people are very worried about in the bond markets, and Gillian's saying, is this going to happen in the stock markets? Too, we have these big forces at work. We have large quantities of public equity being concentrated among like Blackstone, Vanguard, and robo-advisors. You've got the smaller financial advisors, which are being cleared by Schwab and Ameritrade and Fidelity. What happens, she says, when the robo-dictated strategies and the human-managed funds and the ETFs, and they all decide to sort of trigger, or they all need to shift positions at the same time? What happened? Are we risking? Is there a big risk of just the floor sort of like falling out of this because there are no real liquidity providers, even in the equity market anymore, like let alone in the bond market?
You mean like what happened in 2008 before all the robo guys took over? Yeah. It's nothing new.
That's right.
People like to look at, there's a class of people that look at technology and look at advancement, and they get very scared. But then I think people need to take a step back and compare it to what we used to have and how it used to work, even in very recent memory. And I think in most cases you're going to find that the advantages outweigh the perceived disadvantages. We've always, in fact, quite frankly, human-managed money is much more susceptible to emotional decisions. Humans are very emotional. Even the most professional money managers are they're people after all. They're just like all of us. There's people get fearful of conditions. People overreact. I mean, these are well documented psychological phenomena that are very hard to control, and it led to an exacerbation of the financial crisis. Everyone was doing the same thing at the same time. I think, frankly, there's hope that more algorithmic approaches, more or AI, I prefer to call it approaches, would de-emotionalize many of these decisions, reducing the chances that everyone will, in fear, pile into the same thing.
So, but the question wasn't 2008. I mean, the question was clearly 2010 was the flash crash. If that had happened on a Friday afternoon and it hadn't had a chance to rebound before the close, and then you wound up having a panicked weekend and Asia opening, we could see a glimpse of something really quite systemic and dangerous happening.
But in the old days, there were many market failures where the specialists on the floor of the New York Stock Exchange refused to answer their phones when the market was moving in the wrong direction. So yes, every exchange system, every market structure has pluses and minuses, and it's very important. So yes, the flash crash occurred. People should analyze it, learn from it, make changes and improvements, absolutely. But this is the natural progression.
Yeah, and I would say this. I mean, first of all, I think there's herd mentality exists whether it's a human herd or a machine herd, right? So that's always existed, and I think it will always exist. I think also the great thing about having humans in the process is there's always someone who's probably willing to take a contrarian position, right? So they might look at it and use their judgment to say, this doesn't make sense. I don't see any facts that back this up. I'm going to come in and start being a buyer, right? And machines could also make that decision. So I do believe that there's self-correcting mechanisms because of the breadth and depth of the investor base. But also after the flash crash, obviously the markets looked at it, and we did our own investigation, as David mentioned, and our own self-assessment, and realized that there's circuit breakers and other things that we should be putting in to make sure that if something happens in computer speed, that we have the ability to stop it and make sure that we make a human decision as to whether or not this is appropriate behavior or not, and then restart the market.
I think there's also another part of that, in that, frankly, we don't know. Our new reality is we don't know. As these technologies come to be, and this opportunity, we won't know what AI or robo-advice looks like in a 20% market correction. We don't know if it eliminates that risk or if it makes that risk even greater. And
well, there is actually, we have a little bit of data from Betterment, which is one of the two big robo-advisors.
But Betterment hasn't experienced a 20% market correction
No, it hasn't.
Yet.
But
so until we go through that point in time, I think it's hard to say that this is the saving grace of the industry. It's something that we're all going to have to worry and evaluate.
Yeah, it's true there's a lot we don't know about, but intuitively I think, if you have a kind of set it and forget it strategy, you're less likely to panic than if you're having a sort of phone call with a human being who is fallible and prone to panic. But before Adena, I want to just pick up on, because you're very close to market structure and this kind of thing, I just want to ask the panel here, with you first. Do you believe that Navinder Sarao caused the flash crash?
I think a confluence of many things caused the flash crash.
Does anyone, quick show of hands, does a single person in this room believe that Navinder Sarao caused the flash crash? One? No one? One. We found one. This is obviously in the news. We have this guy who's working out of his parents' basement in Hounslow. He is being hit. Talking about the confluence of technology and regulation, he is being hit with the most insane amount of extradition requests, criminal charges, you name it, for trading E-mini futures from London. tell me about how is it that the regulation of this market seems to be really good in terms of being incredibly aggressive against incredibly tiny people and very little aggression against anyone who actually matters?
I'm not going to take that one.
Never saw us be so quiet.
But what I related to your point, but definitely not answering your question. I think it's very important to make the point that all robo advisors, all algorithmic trading approaches, all AI systems are not created equally. Just like you can you go to any human investment manager, everyone will have a different opinion. Everyone has a different approach to making investment decisions. A lot of people who aren't practitioners of the algorithmic approaches, to me, many, not all, but many seem to think that they're all very similar, and that ultimately you're going to end up with essentially one. It's almost like there's either the algorithmic approach or a vast number of different human approaches. Well, it turns out that there are a vast number of different algorithmic ways of doing things. All algorithms are not created equally. There's a tremendous amount of diversity. There's no reason to think that just because people are moving to more algorithmic approaches, everyone is doing the same thing. I mean, that's quite not true.
So is there? I just need to check because this email thing has worked quite well. But are there any Luddites in the room who haven't emailed me who have questions for the panel? Because we can do it the old-fashioned way as well if we want to. There's one over here.
Yeah, just wondering what...
Wait, hang on one sec. We need to bring you a microphone so that the good people following along on YouTube can hear what you have to say. Here it comes.
Thank you. Yeah, there seems to be a lot going on in the Forex space, controversy and scandals in some aspects.
So many other. It's not just bonds and stocks.
Yeah, apparently.
Currencies and LIBOR and rates.
And all that. And technology obviously can have a big impact there. I'm wondering if any of the panelists have any view on what impact in the next couple of years technology will have on global Forex trading. That's a technology question. Then maybe also on the impact, if any, of the international trading of the Chinese currency as maybe attempting to be some kind of reserve currency.
I might try the first half of that question. You're absolutely right to point to the events that everybody in the room is well aware of with respect to Forex. I would say with that, I actually don't think that that's a technology issue. There might be a technology solution to helping us avoid these issues. These are cultural issues. These are rogue. Effectively, every single one of them is fraud in some way, shape, or form. So the question then becomes, what are the governance systems? What are the technology monitoring systems? If you have the proper transaction monitoring systems to be able to detect or not? Is it possible to even have a perfect technology system to detect anything? And I would argue it's probably not, because there will always be some smart people out there who will find a way to do things if you just let everything run its course in the normal course. So I come back to something that might not sound very germane to this panel at all, but I think the culture of the institutions and the actual behavior of people, which I think starts at the very top of these institutions and gets driven all the way through, is probably midway through its fix. And I don't think that, I think most people would agree that it's not there yet. I also think it's in the extreme minority of participants who have given these industries and these participants a very bad name, like very extreme minority. But I think that there's a lot there that is away from technology in terms of prevention, but technology has a real role to play in terms of detection.
So in terms of the milk and conference drinking game, we do get the China drink in here, but I think this is actually worth asking, especially with regard to what you were talking about, how the technological innovations are more likely going to be coming from outside the US. It's very early days yet, but do you see China being a sort of financial technology disruptor of the sort of capital markets as we know them, and not just in stocks, but also in things like foreign exchange and rates?
I think more likely, and in my experience in China, that they're actually quite good at studying the way Western markets work, and they are building a very strong regulatory infrastructure in the country. And so I suspect that they're going to have a very orderly progression into a more modernized financial system. That it's a very engineering-oriented culture to begin with. I actually think the area, as I said before, that is more exciting is the less developed parts of the world, where there's really no financial infrastructure to speak of, and there, the peer-to-peer approaches are extremely appealing. Banks aren't going to open up branches in all these small villages, but if your iPhone can be turned into a banking center, if you can buy a micro-insurance policy on an app, that's extremely appealing. And so there's huge demand. It's still in the earliest of days, but the innovation and the regulation is very light there. So if anyone is interested in really starting a company to do financial innovation in those spaces, try it out in Sub-Sahara. You'll be able to do it.
The regulation is very light if you happen to be a extremely powerful telecoms monopoly. But thankfully, those are the ones doing the innovation. We have room for one more question right here in the front row.
I don't mean to throw a wrench in the equation, as I'm certainly a fan of big data. I'm certainly a fan of Two Sigma in particular. But I guess we haven't really touched on the maybe limit considerations in some of your businesses. So, you're certainly providing a lot of ways for investors to sort of streamline what they're trying to achieve. But in my line of work, in particular, we're focused on impact investing, run a hedge fund in that space. And so we're trying to help investors make a two-dimensional investment approach. So not just financial return, but also ESG considerations. And I think that, there is a point to which technology, in a sense, almost makes humans irrelevant in the equation. And I think there's a reason why we're all here congregating rather than just, chiming in through YouTube. I think the human element is incredibly important. So how can technology best, instead of big data, perhaps smart data, to help make most informed decisions for investors?
So this is an absolutely amazing. I love this. This is the perfect layup to end with. Quick, final 30 seconds. Where is it that humans will always be able to have an edge over machines and can make the world a better place?
Well, I'll start by saying forever is a long time, but for the foreseeable future, my view would be that the role of humans is to work very closely. So the algorithms are being written by humans. The approaches that we use at my firm, there are lots of people that are being very creative. They're not the traditional people that work in the financial services industry, but these are more of kind of the engineering, big data types of folks that you'd find in Silicon Valley startups. But they're working along with traditional financial professionals to take the ideas that have always been used in investment management and to transfer them into algorithms. And so I think that essentially the industry and the investment side needs to be much smarter about how it uses the data and the power of computing.
Daryl?
I'd come right back to where I started. I think there's a place for all of the above. I think that the conversation that we've had over the last hour has pretty much suggested that all the way through.
Adena?
Yeah, I like the word smart data because I think that at the end of the day, first of all, you're right. Humans are the ones who are creating the algorithms or coming up with the investment model. Nasdaq actually owns a smart beta indexer called Dorsey Wright, and they come up with an investment model that then creates an outcome-oriented index that people can invest in. You also can conceive of the concept of an index for one. So you can say to an investor, as you said, they want to have impact investing, so they have certain things they care about, and they should be able to enter that into the equation, and either through a human or through a machine, be able to understand how best to make those investment choices. So I think there's always going to be a human involved, whether it's at the end of the road or somewhere along the way. I believe that those judgments are important.
The panel's Digitizing Wall Street. Digital communications is the way that you need to make people aware of the investment choice they have. We've eliminated 60% of the paper and postage and proxy, but getting people information about their investments, where $20 billion is still being spent, getting your message out digitally, is something you have the ability to do, and that will make the difference in enabling individuals in particular to see the difference in investment. And 30% of the investment market out there in equities is individuals.
And that's I think, a good place to end it.
Well, before we end, Felix, I'll just say one thing to
yes.
your question. I think you highlighted the role of the financial advisor in this big equation. And it's relationship driven, and you're right, we'll never sit, in my opinion, and whether it's a YouTube conference or any other conference, there will be an introduction, there will be a know your client, there will be an understanding of goals and strategies, and we're big fans of impact investing. And until you tell that story, it's not always understood by everybody what that investor is trying to achieve. Yes, it is a return-driven strategy, but the opportunity to invest in socially impactful ways is of great importance to a lot of people. So you, again, have hit on why financial advisors will embrace technology, and we love to see and hear the conversations around the algorithmic structures and how to invest better. But at the end of the day, there needs to be a facilitator. And that's, I think, the opportunity.
And the one thing which I'm going to take away from this is that the technology side of things can help investors talk to companies, can help investors talk to the world, and not just receive information more efficiently, but actually talk back. Thank you very much to the panel, which was fantastic, and I hope you learned something.